preparing to purchase a veterinary seminar. So let's jump right in. Here we go. What to expect, just a brief overview, not tonight, but this morning. How to locate a practice, assembling your team, obtaining financing, analyzing the practice, understanding agreements, seeing what comes up that you don't want to be there, how you go about making an offer, and setting up the practice for success. So it's just part of the process how you're going to locate the practice that you're interested in that fits your needs. And then the steps to obtaining that and all the way through due diligence to closing to business operations. And if anyone has any questions, just raise your hand in the chat and I'll periodically be checking the chat. Okay. All right, about Omni Practice Group. So Omni started in 2004 by Rod Johnston. And here we have Washington, Oregon, and California, but actually we're in several states in addition to this. We're also in Nevada and Idaho and New Mexico. We're on the East Coast. We're in almost every state, Colorado, Texas. And here's some of our memberships, members of the National Association of Practice Brokers, Institute of Business Appraisers, Practice Valuation Study Group, Washington State CPA, and Commercial Brokers Association. So most of us are commercial real estate brokers. Several of us have accounting degrees. We have 3 certified valuation analysts on our team. We have a full marketing team. And then we've transitioned over 350 healthcare practices in the last 15 years. And again, now we're in several states. We focus on personalized service, transparency, trust, and integrity. And again, consultants, a wide variety in our team, CPAs, MBAs. We have a couple veterinarians on our team as well. Some of our services that we offer, transitions, seller and buyer representation. We don't do dual representation. We'll do represent one in the transaction. Valuations, again, 3 certified valuation analysts on our team. We do a valuation before we list any practice that we sell. Real estate services, again, like I said, most of us are commercial real estate brokers. We do assist with startups. And lease negotiations, that's a big part of the purchase sale agreement at the end of the process, and acquisitions and dissolutions. We do offer consulting to some of our sellers are wanting to sell to an associate, and we help them put that together. Here's just some trends. Over 50% of graduating veterinarians are female. Actually, that statistic, I read something today that 80% of current veterinary students are female. So that has gone up. 50% of graduating veterinarians do not want to own. We're trying to change that. It's so much more beneficial to own your own practice, both economically and mentally, in my opinion. We all know corporate veterinary companies are growing. Consolidations are happening. Multi-practice owners are growing out of necessity, to compete. And baby boomers are reaching retirement, lots of retiring veterinarians. So it's really great. Some of these solo practices too are very profitable, and I encourage looking at them. There's several on the market right now, and the solo practices, in my opinion, are the best deal. You're going to get the most opportunity for your money. You're going to be able to make those margins and be able to grow the practice into what you want it to be. Currently a seller's market, well, that's changing a bit. Number of practices being sold is steadily growing. That's true. And more veterinarians retiring than graduating out of vet school, also true. And graduating veterinarians average debt over 150,000. Banks love to finance veterinary practices, and that has not changed. And good practices do sell quick, good location, high profit margin, high gross revenues. That practice is very desirable. And there are several practices that also include real estate as part of the deal. I know it depends on the veterinarian if that's what you're looking for or not. Okay. Are you ready to buy? So have you been out of school at least 2 years? This is very important for financing purposes. Plus, you're going to want to have that practical experience. Do you have adequate experience with major procedures? You're going to be running this facility. You can't be afraid of surgery. And can you qualify for a bank loan? And we'll go through some of that. And a lot of the requirements, it's a lot more lenient than if you're purchasing real estate with the practice. If you're trying to buy a house, a bank loan for a veterinary business, um, there are requirements, but I would call them minimal requirements. As long as you have a certain amount of minimal assets on hand, banks are happy to loan to you. Have you managed a staff before? Can you wear many hats? HR, marketing, PR, CFO, and janitor, and to educate yourself. So this is the business aspect, which I notice a lot of veterinarians when they're starting out, this is very intimidating for them. And this is a portion that tends to be lacking in their veterinary studies is not only do you need to know how to practice veterinary medicine, but you need to manage a business and you need to manage a full staff. You need to manage your accounting team. You need to market your practice. There's a lot more that goes into it than just practicing veterinary medicine. Willing to accept a practice that is not perfect. So this is important too. I mean, when you're looking at a practice starting up, and we're going to go through things to look for benchmarks to show a practice that's going to be successful in acquisition, but you might find a practice that's not going to fit every ideal, but you can make it into what you want it to be. And as long as it hits certain benchmarks, that practice is going to be a huge success. So pros of buying existing practice. So this is something too, because some people want to build a startup so that it fits their vision, but startups cost a lot more money. You don't have existing staff. So here's the pros of buying existing. You have existing cash flow. You're getting staff on board, which we all know that staff in the current environment are hard to find. There's already a system in place, and you can improve on that system and make it what you want. You have a patient base. And again, starting up with purchasing a practice that has a high margin, you're going to be able to pay off that loan within a few years. Cons of buying existing, older equipment, that happens, and that's part of your due diligence. You're going to go through the equipment list. Unknown staff, you don't know how these people are going to working under you. You might have to change the systems. These guys are entrenched. It could be a practice that's been operating for 30 years. All your records are paper. You're going to have to change some things around, modernize some things, and hidden skeletons, which we'll talk about in a little bit. Assembling your team. So this is your team when you're looking at a practice. You want your accountant. They're going to help you look over the financials. You're going to be requesting financial records once you identify a practice that you want to purchase. An attorney, you're going to need an attorney to assist in the purchase sale agreement. A consultant broker, of course, I recommend Omni, and a banker. So one of the things that we always recommend is when a buyer is going in to purchase a practice, that if they're looking for bank financing, they go to 3 different banks. Steps. So here's the steps, sort of from the start to going through to finish. So you're looking in a certain geographic area that's desirable for you. And you locate, you see some listings, you see some that are appealing. Again, there might be a couple just outside your area, and it's worth looking at. Every practice is different. There might be a practice just outside your radius that hits those benchmarks that you're looking for, the signs of a very successful business venture. So I encourage you to look, just be open. And so once you locate it, you sign the non-disclosure agreement and you receive the data. So usually for our listings, we send out a prospectus, sort of an introductory marketing tool. And so you're going to go through and review that. And then you like what you see, you reach out, you ask some questions, you schedule a showing so you can see the practice in person. After seeing the practice, you've reviewed the financials, this looks like a good opportunity. The next step is to make an offer. And we do that through an LOI, a letter of intent. And either you can use your template to generate the LOI, or Omni also has a template for an LOI. And I know for our practices, we pass that LOI back and forth until we get signatures on both and terms are agreed upon. And then you're going to work with the banks to get financing started. And then the hard part, perform due diligence, lots of records to go through, contact your attorney to start the legal work. You're going to start negotiating that purchase sale agreement. Then you need to negotiate that lease, which is also a big part of getting financing. And then the final step, close on the practice, sign and begin operations. Where to look? So I recommend Omni. Reach out to us, contact us for listings, visit our website, omnipg-vet.com. We have several listings in several states. And I also, here it says Washington Veterinary, change that to California, Texas, Nevada, any state that you're looking in, where you're looking at looking for a practice. So Veterinary Association classifieds. I know in my area, one would be the Southern California Veterinary Medical Association. There's the Central California Veterinary Medical Association. You know, there's several. And then there's the state California Medical Association. So alumni sites. So in California, UC Davis, Western, and county veterinary associations, other sites. Working with a broker. Again, we're not all created equal. Again, Omni integrity is a big part of our business. We don't practice dual representation. We want to fully represent our clients' interests. We do not want to be compromised. Every practice that we sell has a non-disclosure agreement, and you know, we do not want anyone spreading information on a seller's practice, sabotaging their sale. You know, we do not want staff knowing about that the practice is for sale. Requesting information and know who they work for. So this is a big part of it. Like, you don't want a broker that's working for a corporate. You know, it's not going to be in the best interest of the client. It's in the best interest of the corporation. So your ideal practice location. So this is going into some of the things that you are looking for a huge successful business venture. You want greater than 2,000 patients per doctor. Looking at the area, you know, when we send out a prospectus, we send out some demographics, and you want to look at the information that's listed in there. A higher percentage of homeowners to apartment dwellers. Household income higher than the state average. So, you know, obviously you want clientele that's able to pay for their veterinary services, that love their pets. Majority of the age group in the 30 to 60-year-old group. Good visibility. And of course, you want to make sure that it's outside. If you sold a practice recently, I noticed a few that signed up have other veterinary practices, and say you sell one to a corporate, you're probably going to have a non-compete. No one wants to buy a practice and have the veterinarian set up shop next door. So you want to make sure it's outside of your radius for your non-compete agreement. That's very important. And other things to look for, when you're looking at a practice, parking, accessibility. You want it to be accessible. So we're going to look at the average practice versus the ideal practice. So average, you have 450,000 in collected production, your gross receipts. Your overhead is at 67%. You're operating at 91% collections. Your staff, not a big staff, one front desk, a vet tech, and 2 vet assistants, and say you're 54 years of age. So, this is a profitable practice. You're doing okay. This is your average. And this is your gold star standard. So ideal. Your overhead of 65% or less. 2,000 active patients, upward trend in growth. So that's important, 10 to 15% per year. If you had a recent remodel, that's great. That's less that you have to do when you purchase the practice. A seller willing to stay on for up to a year, they'll help you transition into the clientele, knowing that there's a new operator. 4 exam rooms with room to grow, staff production of 20 to 25,000 per staff member per month, and everything digital. So not every practice is going to meet all these standards. If they hit the majority, that's great. If you have high margins, you're going to be able to keep those margins and improve it. You can pay for some upgrades. A few, it depends on what you're paying for. 4 exam rooms, that's a fairly large practice. So, and then digital, most practices will have digital equipment, but some of these veterinarians that are ready to retire, they've got paper records dating back 30 years. So, and here's some benchmarks. So things to look for when you're looking at the practice. So again, these sort of tie with that ideal that we were just looking at. So your doctor of veterinary medicine, your associate, you want 22 to 25% of total collections. Production, again, 20 to 25,000 per staff member, and you're doing really well. Total overhead, 63% or lower, you're doing great, and this is something I want to expand upon a little bit too. So total staff compensation, 22 to 25% of your collections. Your rent, you're looking in the area 7 to 9%. Marketing 3 to 5%, office supplies 1%, and your office space average about 320 square feet per room. It's just the average of the total space involved. So some of this too, like, when you're looking, and I have veterinarians looking in very high value areas, you also need to look at the margins. So when you're considering a high value area in comparison to an area that might be what you consider a little lower value, say you don't think the clientele will match the business that you're performing, but I encourage you to really look at these numbers and these benchmarks and these margins. So some of those areas that are in outlying areas are so much easier to meet these margins because things like your rent will be so much lower. Just your operating cost is going to be lower, mainly rent. So say you found the perfect practice. This is meeting your benchmarks. It's what you're looking for. It fits your vision. You're going to contact the seller or the seller's broker. If the seller has a broker, you're going to need to reach out to that broker. Read and sign the non-disclosure agreement. Like I said, all of our listings have a non-disclosure agreement. We have a separate agreement for every listing. Review the data you have received. So you have your prospectus that gives you the general overview. So you start with that, and then you request the tax returns, and you're going to look and match up the tax returns to those benchmarks as well. And your practice management reports. So you're going to take a look at the production of the practice. And again, the lease. There are items in the lease you want to make sure it's an assumable lease, that you can transfer it and have a long term when you purchase the practice. And again, that is essential if you have bank financing in place. The prospectus. So this is a quick overview of that initial document that we send over when we get a request. So it provides generalized information on the production procedures. Then patients, a lot of us will list the average number of patients per day. Value for the practice, valuation, price. We have some items from the valuation that we include in the prospectus. And every practice, like I said, that we list goes through a thorough evaluation, and that's how we come up with the price for the practice. A list of staff. So this gives you a general list of the positions that are being filled in the practice. So you have an idea of what's necessary for operations. Major services that are performed, a fee schedule, and demographics. And here, so required financial information. So we want a minimum of 3 years tax returns for the practice. This staff pay, W-2s, hours worked, hourly pay, or salary. So this comes after you've signed the LOI, and then you're going through your due diligence, and you're gonna need this detail prior to your purchase sale agreement. And again, associate information, pay, and contract. P&L statement, you're going to ask for that probably early on when you're analyzing the financials of the practice, depreciation schedule, and a list of assets. I see someone raise their hand, and at the end of the webinar, I will take some questions at the end. So let's hold off for a minute, and then I will go through the questions, okay? And so here, some required practice management reports. So these are some production reports you're going to want to look at for the health of the practice. So production by procedure, production by provider. Obviously, if you have one doctor in the practice, that's going to be a fairly simple report. Fee schedule, accounts receivable, aging balance, and accounts receivable aging. So most veterinary practices don't have a big accounts receivable aging. Usually it's pay at the time of service, so you don't see many practices that have a large balance. Analyzing the data in the prospectus. So this is the first document we send over. So you're going to want to look through this before you follow up. I mean, everyone's going to follow up with additional questions. It's your introduction. So you get an overview of what the practice is about. You get a feel for the size of the practice. You can initially look for some red flags. Here you're looking for the fit. So type of practice, small versus large animal. Most of you are looking for small animal clinics. Are the procedures similar to what you do? I've had some listings where the veterinarians have cut back on the procedures performed because they're getting towards retirement. Maybe they can't perform everything that they did 20 years ago. And this isn't a bad thing. And in fact, this is an opportunity to increase revenues in the practice. You know, you're going to come in and suddenly services are going to be expanded. Collections, are they about where you want them to be? Staffing, so you're going to look at how much it's going to cost me to staff this practice. The number of rooms, the size of the practice. I know some of you are looking for second and third locations or more, and it's important to you to have room to expand. The type of practice, and do the demographics look reasonable? So you're looking at the area, you're looking for growth potential, you're looking at your clientele. So we're going to do this looking at the data in the tax returns. So we're going to go through this a little bit for things for you to look for and things for you to go against your benchmarks. So you're going to do a comparison. Look for anomalies against the benchmarks. Take note, there's questions. There might be a reasonable explanation. Sometimes things are listed in that business or combined that wouldn't be there if you had purchased the practice, and there's a reasonable explanation. So it's worth a question to find out why that looks out of place. Look at the depreciation schedule, see when the assets were purchased. That's important. You need to know how old the equipment is. Reconcile collections numbers back to the practice management reports. Look at non-operating expenses being run through the practice. Again, like I said, that goes back to those anomalies. That's worth a question if you see something that seems out of place. And look for trends in collections up or down. It's fantastic. You get a practice that's increasing every year they're in business, or every year within the last 3 years, right? They're showing this upward trend. Big discounts, trades showing up, those red flag. And then, have your accountant take a look. So, and here is a sample tax return. So here we're looking, some of the marks we're looking at here are, we want to see, your gross receipts right here. You're looking at salaries, how much the salaries are paid. You're looking at employee benefits. You want to see where you're at there. That's going to be included, and you're going to combine that with your salary number. You're going to combine any employee number up there. You might want an expansion. So this is only a snapshot of the first page. So there's schedules with more detail too that back up this data. So you're going to want to look at that. So look at your payroll taxes, combine that with your number for staffing. And here you're going down, I think there's an advertising expense in there. So how much do they spend on their marketing? And look through the schedules that are attached to the return. You're going to look at the income statement. You're going to look at the balance sheet. You're going to look at the depreciation schedule. Those are all very important. So here, back on our tax return, we're looking at this, and then we're looking at some of our benchmarks that we're just doing a comparison, some percentages, right? So collections, this return, as you saw on the other page, it was 692,246. That's fine. We're at 100%. Staff compensation, what percentage of your staff compensation? This is the salary, your benefits, all your staff expenses are combined into this number. And here you have an actual at 29% versus 25. You're like, oh, that's a little high, right? It's only 4% higher, but it's a little high for that. So facilities, 85,630, 12%. You want that at 7 to 9%? That's a little bit high. Again, that's part of your margins, right? Your marketing, 1,286. Well, that's right on track, right? You're at 0. And your benchmark was 3 to 5%. So you're pretty good there. I mean, it's not quite 0, but it's low. And then office supplies, your office supplies were a bit high at 3%. I think we had 1% there. Here it says actual and benchmark so that they're matching. But I think we had mentioned before, you want that at about 1%, but 22,377. So this is what you're comparing, and you can allow some allowances to be over. I mean, less than is always great, right? It's what is acceptable to you. And then this is also a guidance so that when you take over the practice, it could be that you could change a couple of these percentages and change the ratios a bit. I mean, you're hoping to increase revenue for one, right? There might not be much you can do about the facilities costs, but increasing revenues, you definitely don't want to reduce staff compensation. So look at that. I mean, obviously office supplies and marketing you can adjust. Analyzing practice reports. So this we talked about production by procedure, production by provider, your fee schedule. You want to know what they're charging for services currently. You want to know, it gives you maybe you're going to want to change rates after a year in business. Accounts receivable aging report. Again, most practices, this is negligible. But of course, we want to look at that. And viewing, so when you go to look at the practice, you did your benchmarks, you're looking at the tax return, practice numbers, they mostly match, it's acceptable to you. And you contact the seller or broker to set up a showing, an appointment to see the practice in person. So when you're looking at it, think of it as how your clients are going to see, the look, feel, technology, and also see, a lot of veterinarians, when they take over, they're going to change a few things. So how do you think the client's going to view you being in that practice and doing those upgrades? How many parking spaces? I mentioned that parking is huge, especially in my location. When was the last remodel? Technology, how old? Should be all digital. You want your equipment to be modern. How's the location, the visibility, the signage, the accessibility, right? And again, all the equipment so that you can just start over and get running and start getting your numbers up so that you can finance any changes through the business. And then, so say you're ready to move on to your next step in the process. So you're ready to make an offer. So you're going to contact the seller, or if it's through a listing, you're going to contact the broker and start discussing the offer. And again, letter of intent. So you can have your template, or for us with Omni, we have our own LOI that we can fill in, and then we facilitate that communication between you and the seller until you both agree on the terms. And so here is a description of what's in the letter of intent. And it is a non-binding legal agreement. So basically, we want to put some components in this letter of intent that you and the seller agree upon. And basically, you are proceeding at that point in good faith towards a close. So it's a non-binding agreement. In that letter of intent, you're agreeing on the price. Is there going to be a non-compete? You don't want the seller to, again, like I said before, to open up shop a block away from you. So seller working back, do you want them to help you transition the practice to, the clientele until they get used to your presence being there? Building purchase, is there real estate involved in the practice? Accounts receivable, so you're going to want to purchase the accounts receivable if there are any, and contingencies. And we're going to speak a little bit further about what those contingencies could be. All right, so here, LOI contingencies. So is your offer contingent upon the following? So any of these, so you want satisfactory financing. So if you can't get financing, obviously you're not going to be able to follow through to the purchase sale agreement. Lease or purchase of the building. So I know a part of financing is that you have a 7 to 10 year lease in place for your financing. So, and if you want to purchase the building, is that something you want to have included? And you also will need separate financing for the purchase of a building. Due diligence of the practice books, equipment, and other. So you want to make sure that your due diligence is complete and it's to your satisfaction. Audit of patient charts. So you're going to go through those. Approval of the terms of the purchase agreements by advisors, and assets transferred free and clear. No one wants a surprise lien when they're purchasing a practice. So you want to make sure that there's clear title and you can transfer all those assets. This is an asset sale. Seller's agreement to restrictive covenant, 5, 10 or more miles. So yeah, again, you don't want them setting up shop next to you. And we already talked about that. Is your seller going to stay on and help you transition? So you can put that in your LOI as part of it. And then, this is all things that items that need to be satisfied prior to completion of the purchase sale agreement, right? So here is something on determining the price of the practice. So again, like I said, every listing that we do a thorough valuation. We usually use 3 methods when we're going through our valuation. We average them together. We come up with a fair market price. So here is just some when you're looking at a practice. So rules of thumb, be careful with that because a lot of people will say, oh, I'm buying a practice, it should be 80% of gross revenues, right? 85%. So it's not always the case, right? You have to look at your margins. So which is the better deal here? Here's an example. A practice that has 1 million, it has gross receipts of $1 million and it has a price of 700,000, or a practice with gross receipts of 800,000 with the price, same price, 700,000. And you're like, oh, look at this. I'm 1 million, it's 300,000 more that's grossing, right? But you have to look at your margins within that practice. So the $1 million practice has an overhead of 85%, taking home 150,000, whereas the $800,000 practice has 50% overhead. And look at that margin, taking home 400,000. So obviously you're going to be making a lot more with the one that has gross revenues of 800,000, and not including that, the potential for you to expand on that practice's business. There's lots of different benchmarks to look at. Has it been increasing revenue over the last 3 years? There's more that goes into it than just gross receipts. So here, the $800,000 practice is a better deal. So. And valuing a practice. So practice values. So this goes into a little bit about how we do our evaluation. Here's some components: collections, adjusted income, and assets. You start with the tax return. This is how you are going to configure the net income for the practice, adjusted net income. So you're going to add back non-operating expenses, so the amortization, depreciation, owner's salary, owner's benefits, travel, training dues, automotive meals, anything that stands out that's not a normal operating expense. And that's going to give you that adjusted net income number. And then you're going to adjust the book value on equipment from the tax depreciation schedule. And then here, like I said, I mentioned this previously, that when Omni does evaluation on a practice, we usually use these 3 primary methods, and we're going to average them together. So asset accumulation, the book value, and the goodwill. So production acquisition is historical sales, it's sort of comps in the market comparatively, and the capitalization method. So, and we'll talk a little bit about this too, about goodwill. So here is just a little bit about how you came up with your adjusted net income, and then the 3 different methods that are in here. So here's your adjusted net income, and you're taking out your expenses, your net income, and then you're adding back in for the adjusted net those non-operating expenses I mentioned previously, and that's how you come up with your adjusted number of 170,000. And you're using that adjusted net income when you're doing the other methods in the valuation. So your asset book value is 300,000. You're going to remove depreciation, so you get your actual. And then goodwill. So this is a percentage that's used, and it is usually between 50% to 200% is the number that we use. And it's based on a variety of factors. So has the business been increasing income for the last few years? Is it in a good location? A little bit of it will be reviews. There's multiple factors that go into that. So you come up with a goodwill value, and then here's your bottom total when you're adding those together is $370,000 for that practice. And Here's another one, production acquisition. So you have collections at 500,000, which is your gross revenues number, and then your historical. So that's going to be sort of comps for similar practices within the area. So you're at 70% and your production acquisition value is 350,000. So capitalization method, again, you're taking that adjusted net income number that you came up with, and here you take out the associates pay. Your excess earning is at 65,000. You're using a capitalization rate of 20%, which is an industry standard. And your capitalization value is 325,000. So we're going to take those three, we're averaging them together. And your final value, that's how we come up with that. So that practice that had gross receipts of 500,000 is going to be priced at 348,333. So it might be rounded out to 348,000. So what do you offer based on that? So you're looking at the prospectus, that's the price. You've looked at the tax return, you've done your benchmarks. So if you're offering a number lower than the valuation, but you need to be reasonable because we just went through all those methods of valuing the practice at where it should be in the market. So when you're doing your offer, a 10 to 12% discount is a starting point for negotiations. So start there. And then you're going to go back and forth with the seller through the LOI and the LOI gets changed every time until you agree. And then both signatures end up on that LOI. Include all the contingencies that you can. If everything goes well and you're able to get all your records and you're in agreement with the seller, you're closing within 2 months. If there's competing bids, include CV, the bank letter, other documents to increase your odds. Bank financing. So we touched on this a little bit. You have to be two years or more out of veterinary school. School debt, banks know that you're going to have school debt, just have it under $300,000. They expect veterinary school debt. Limited credit card and other debt. Yeah, they don't like the outside debt. A home mortgage, they understand that one. 2 years of tax returns and personal financial statements. Banks are tightening up a bit. You know, interest rates have been going up a bit, but they're still so much lower than they were several years ago. Say 30 years ago. You know, a lot of veterinarians that are retiring have told me the stories, you know, where their interest rates were at when they bought the practice, and they were more than double where they are now. So, and some of these sellers are willing to carry back. So I know I have a client right now that's willing to do that for the right candidate. So, and they'll carry back part of the note at a lower interest rate. If the building is included, this is separate from a veterinary loan. So this is real estate. So they may ask for 10 to 20% down on a building. That's not out of the norm. And still, banks are more than willing to fund veterinarians. They love veterinarians. The practices rarely fail. Veterinarians are recession proof. So everyone loves their pets. They're going to need veterinary care, and banks know this. So going through due diligence, this is a big part of the sale. So spend an evening or a Saturday doing detailed due diligence. You want to go through the records. So you're going to verify those active patients. So count the charts, review a good number of them, get a picture of where they're at, start your review, keep going. And then once you're comfortable, you know, then move on. View charts for past work and future work, and the notes. You're going to want to see, you know, see their procedures, see how they've been conducting it, how they document their client visits. Have an equipment dealer check out the equipment. You want to make sure you have what you need when you're starting the practice. This is a little bit about skeletons. So does the practice management report tie to the tax return? So basically, we're gonna run through this kind of quickly going through. Basically, you're looking for those anomalies, and you know, you reach out to the broker, ask questions. You know, like I said, some of those, if something's not matching, maybe there's a good explanation, but you need to know why. So run an audit report, review credit adjustments, split of duties. You know, as a doctor, you want to look, is it one person that's doing all the deposits? Is it one person with access to the records? You know, if things are matching up and things look good, then you're probably good. More skeletons in here. So you're going to review staffing. You want to review treatment. You don't want to be, you know, you want this veterinarian to be honest. You know, are the treatments in line with what they should be? They're not upselling their clients. Lease issues. You want to make sure the lease is in market rate. Equipment problems. You want to make sure that you have good working equipment, right? Agreement. So your attorney is going to begin preparing the agreements, your purchase sale agreement after due diligence. So again, you know, part of it is purchasing accounts receivable, but those are usually negligible. Most practices don't even have accounts receivable. Make sure your lease assignment is going well, that it transfers over to you, that you have a long-term lease, covenant not to compete. And if your veterinarian's working back, and then lastly, your bill of sale. So your purchase and sale agreement, here's part of it, major terms, right? Obviously the purchase price, and then work in progress, any progressions on any assets that are coming in later, or any insurance, anything that they've paid for upfront that might be prorated during the course of the year. So those are worked into the purchase and sale agreement. Legalese, make sure the seller disclosed everything, buyer reviewed. That's just the agreement between you. And list of the equipment, that's important. Sold list of contacts, and you're assuming closing date. Sorry, I'm rushing through this so we can finish. Other agreements, covenant not to compete. Again, like, you don't want that doctor to set up shop. We've talked about that. You know, they can't do that right next to you after you purchase their practice. Accounts receivable, this is just part of buying the receivables. And this is a little bit of a formula that can be used when you're purchasing it. And again, this is not really that applicable in the veterinary industry. So lease assignment, that's very, very important. And bill of sale, your official closing document. Final items here, your client letter, you know, and it's introduce our new owner and veterinarian. Employee announcement, you know, the staff are usually the last to know about the sale, and that's usually for the best. Keep everything near the same 6 to 12 months. That's important for continuity when you're transitioning your practice. Staffing decisions, you're transferring your software license, and setting up your bank accounts. And then this is just a little bit, when is it okay to overpay, cost of waiting, that when you purchase your ideal practice, it hits your benchmarks, you're going to be making a lot of money off of that practice. So if you consider that you pass up a practice, it's you couldn't reach a settlement on that price. You know, something came up in your negotiations with the seller, and you lose out, and you lose a year to 2 years of operations in that business, and that can be costly to you. So I encourage you to really look at it and see what you can do to work around. If you find a practice that fits what you need, you know, sometimes it's hard to find one that fits those benchmarks, and it's okay to lose out a bit on the negotiations. So, and then here's just a couple quotes about us, and most importantly, integrity. So I'll let you guys read that through. And that pretty much ends our presentation. So thank you for your time. And if someone wants to raise your hand, I'll unmute you, and you can ask some questions. So, and I do have, I believe Rod Johnston is also on the call with me, and he's our CEO. So he's also available to say a few words, and maybe I'll unmute him in just a moment here.
Can you hear me, Kim?
Yes, I can hear you.
Oh,
So,
okay. Okay.
do you have anything if you want to add? I thought you could add some comments if you want, and then yeah, if anyone else has some questions, I think I see one up here in the Q&A.
Yeah, no, I just great job to begin with, Kim. I just want to say that you know, the market is kind of turning again. You know, it used to be a ton of corporate buyers, but we're starting to see more individuals buying. Doctors who sold their practice to corporates are now coming back and not working for corporates anymore. So they're leaving the corporates and wanting to own their own practice again. And there's a reason they're doing that, because they see the value in owning a practice, and hopefully you guys do as well. So that's all I have to add. It's a good time to be buying practices.
Yeah. Thank you, Rod.
Yep.
And so I had a question in here. Should the 3 years of financial statements that you provide be before COVID? So no, I mean, it's 3 years and you want the most recent 3 years, but if you feel, you know, everything has a story. So we do ask some of our clients to provide up to 5 years. So you could include statements before, and you could include that as part of your story when you're marketing the practice for sale. And, you know, and you can ask for those too. I mean, obviously, if you're looking to purchase a practice, you can ask for as far back as you need to go. So. Any other questions? Just put them in the chat Q&A. All right. Well, if that's it, I want to thank you all so much for joining us today. And yeah, thanks for sharing an hour on your Sunday with me. And hopefully I hear from you soon. So that concludes our webinar for today. Thank you so much. All right. Bye.